Imagine a world where getting a loan depended not on your financial habits, but on your appearance, neighborhood, or even just a handshake. Not that long ago, this wasn't just a hypothetical scenario, it was the reality for millions trying to borrow money or buy a home. The modern credit score changed all of that, transforming risky guesswork into a standardized system. But how did we get here? What do those numbers actually mean? Who decides them? And how can you make them work for you? Here's the story of credit scores, from their rocky beginnings to their vital role in today's economy. Let's rewind to the early 20th century. In those days, lending was more art than science. If you wanted a loan, you'd walk into your local bank, chat with the manager, and hope your reputation preceded you. Maybe you came from a good family or knew someone who could vouch for you. These decisions were subjective, inconsistent, and unsurprisingly, discriminatory. As the economy grew, this personal approach became a problem. More Americans wanted to buy homes, cars, or start businesses, and banks needed a better way to predict who could pay them back. Enter the credit reporting agencies, organizations that collected borrower information and shared it with banks and merchants. At first, these agencies kept files that read more like gossip columns than financial records. John Smith pays slowly, but is trustworthy. Mary Jones goes to church every Sunday, but spends a bit too freely. There were no scores, just information and innuendo. Everything began to change in the 1950s, thanks to two men, Bill Fair and Earl Isaac. Fair, an engineer, and Isaac, a mathematician, believed they could use data and math to make credit decisions more consistent and fair. In 1956, they founded Fair, Isaac and Company, now better known as FECO. Their revolutionary idea was to analyze a borrower's credit data mathematically and generate a single score that predicted how likely they were to pay back borrowed money. This wasn't about who people knew or where they lived. It was about facts, payment history, debt levels, length of credit use, and other measurable behaviors. The FECO score debuted in 1989, adopted first by credit card companies and later by banks and mortgage lenders across the country. For the first time, decisions about lending could be made based on standardized, objective data. The system wasn't and isn't perfect, but it dramatically reduced subjectivity and bias. Let's delve into how credit scores work in the modern era. In the United States, FICO is the most widely used credit scoring model, but there are others, such as VantageScore. No matter which model, the basics remain the same. Your credit score is a three-digit number that summarizes your credit risk based on information found in your credit report. So, who issues these scores? Credit scores aren't handed out by the government. Instead, they are generated by companies like FICO or VantageScore, using data provided by the three major credit bureaus, Experian, Equifax, and TransUnion. Each bureau collects data on your borrowing and repayment habits from banks, credit card companies, lenders, and other creditors. When you apply for a loan or a credit card, the lender will often check your score with one or more of these bureaus. Now, let's talk numbers. The most common score range, the one you'll see in most FICO models, is 300 to 850. The higher the number, the better your credit. Here's a breakdown of what those numbers mean. 800 to 850, exceptional. Lenders love this range. You're practically a credit unicorn. 740 to 799, very good. You'll likely qualify for the best rates and terms. 670 to 739, good. You should be able to borrow without much trouble, though not always at the lowest rates. 580 to 669, fair. You might face higher interest rates or more loan rejections. 300 to 579. Poor. It's tough to get credit, and when you do, it's likely to be expensive. So, what actually goes into calculating your score? The answer depends on the model, but let's look at the FICO score, since it's the industry standard. Payment history makes up about 35% of your score. Do you pay your bills on time? Late or missed payments can drag your score down fast. Amounts owed account for about 30%. That means how much of your available credit you're using. Racking up big balances can indicate you're stretched thin, which lenders don't like. Length of credit history is around 15%. The longer you've used credit responsibly, the better. New credit makes up 10%. Opening multiple new credit accounts in a short period can look risky. Credit mix, another 10%. Having a variety of credit types like credit cards, auto loans, and a mortgage can boost your score. You might wonder if things like your income, age, job, or bank account balances play a role. They don't, not directly anyway. Credit scores focus purely on your credit-related behavior, not on personal details that could be used unfairly. It's one thing to know what goes into your score, but how do you keep it high or bring it up if it's lagging behind? Pay your bills on time. This is the single biggest factor. Even one missed payment can hurt your score and linger on your report for years. Keep your credit card balances low relative to your limits. This is known as your credit utilization ratio. A good rule of thumb is to keep it below 30%, and if you can, even lower. Avoid opening too many new accounts at once. Each application generates a hard inquiry, and a cluster of these can signal risk. Maintain old accounts when possible. The longer your credit history, the stronger your score. So don't close that old credit card just because you don't use it. Check your credit reports for errors. Mistakes happen, and you're entitled to a free report from each bureau every year at annualcreditreport.com. If you spot something wrong, dispute it. Credit scores aren't just about borrowing money. They play an outsized role in modern life, affecting everything from renting an apartment to setting your insurance rates to landing certain jobs. Some employers check credit reports as part of hiring decisions, especially for roles that involve handling money. It's not all smooth sailing, though. The credit scoring system has its critics. Some argue that it's still too opaque. Consumers don't always know why their score changed or which actions will help most. Others point out that people without a long credit history, like new immigrants or those who use only cash, can struggle to get decent scores, even if they're financially responsible. The industry tries to adapt. In recent years, there's been an effort to make credit scoring more inclusive. New models like UltraFICO and Experian Boost allow people to include information like on-time utility or phone bill payments, or even bank account balances in their credit calculations. The idea is to give more people a fair shot at building credit, even if they haven't borrowed much in the past. Internationally, credit scoring takes different forms. In Canada, the main bureaus are Equifax and TransUnion, and the scoring ranges are similar to the US. In the UK, scores aren't standardized nationwide. Lenders have their own scoring systems, though bureaus like Experian and Equifax play a similar role. In many developing countries, however, formal credit scores are rare, and alternative lending methods persist. So, how does everything we've discussed come together in real life? Let's say you apply for a mortgage. The bank requests your credit score from all three bureaus. If your scores are high, you're not only more likely to be approved, but you'll qualify for a better interest rate, potentially saving you thousands of dollars over the life of your loan. On the other hand, a low score can lead to rejection, or the bank might offer you a loan with a higher rate to compensate for their risk. Some people worry that checking their own credit scores will lower them. Good news. Soft inquiries, such as checking your own score, don't harm your credit at all. Only hard inquiries, typically initiated by a lender when you apply for credit, can have a minor, temporary impact. Building a strong credit score doesn't happen overnight, but it's a powerful financial asset. By understanding the history behind the scoring system, what goes into those 3 little digits, and how to manage your credit wisely, you can take charge of your financial story, no matter what your starting point. Today, those once arbitrary decisions made by a local banker have been replaced by a remarkably efficient, if sometimes mysterious, system. The credit score is not without flaws, but it's helped make credit more accessible, more consistent, and yes, more fair for millions of adults. So the next time you see that 3-digit number, remember, it's more than just a score. It's a modern shortcut to trust, opportunity, and with a little bit of effort, financial freedom. If you found this video helpful, please like, share, and subscribe for more financial education content.